everybody, it's Pete Carmasino here at Chaikin Analytics. This is our halftime show on StockCharts TV. Each and every Monday, we try to put out a new video. Last week, we repeated one, so I apologize for that. But today is October 10th. We got a new one going, and obviously, markets are really on the downside today, maybe off their worst levels at the moment. But we're just going to see, obviously, what's happening here today. So we're going to go over, obviously, a macro view, kind of see what's happening from the index level. We have one target that was acquired today on TLT, and just some other just macro kind of events here that are going on. We're also going to look at some charts that are still continuing to break down on our system. We're showing the setups as they appear, and obviously this is in a bear market. We know that, and these rallies that we see, these 1-2 day rallies like we saw last week, Monday, Tuesday, those could just be short covering rallies. Most likely they are. That came after an options expiration. So, you had a lot going on, a lot of dynamics, and we just got to take it day by day, right? I mean, we're talking about, there's just lots of headlines that are repetitive, and it's just the high profile themes, the thematic level of the markets is really just unrelenting, right? It's just a constant reminder that we're talking about higher rates for longer. We're talking about higher energy prices for longer. We're talking about inflation that may not be receding as quickly as we would like. So everything is longer, and potentially sometimes that could equal, I'm not saying it does, but it could equal worse than we expect. And so you've got to just be, very, very careful. There's just no doubt about it. This week, we've got CPI coming out. That's going to be obviously the most important CPI print since the previous one. And I think this week, I'm pretty sure, I wrote an article on this a few weeks back about the Social Security, the COLA. I believe that's being announced this week as well. Some projections were in the 8% range, some were even as high as 9%. It's just an average of the last 3 CPIs is how they come up and determine that for 2023. Last year was about 5.9% in the COLA. And so that could be, again, obviously great news for retirees, those who are taking in Social Security, happy that it's a big raise. It's really going to be a big raise, one of the biggest probably in 40 years based on inflation and how things are playing out. So it's also kind of a drag on the government. Obviously, that's a liability that they have to fund. And we saw what's happening in the UK. And not so much their Social Security, but on their pension market, it's very similar. But we know our Social Security is not obviously leveraged or in the markets or anything of that nature. But at the same time, in the UK market, we saw some pretty bad turmoil there, where they were hungry for yield that they had to turn to leverage and go get it. So all I'm saying is that the fixed income market, and I don't mean bonds here, I mean the income market, people that are trying to receive income, is a liability for someone, right? And in this case, Social Security is our liability as a government and our sponsored programs. In the UK, their pensions are our liability for the folks that run those pension funds. And obviously their government had to step in and kind of backstop their own bonds because they were falling at a rapid pace because of a margin call. So we've got a lot of dynamics here. There's no doubt geopolitical continues to move higher as far as escalation and sentiment and worry and fear. But at the same time, we've got money to invest, and we got to be careful and want to avoid losses and try to squeak out as many gains as we possibly can. So let's dive into the charts and kind of see what we see. All right. Each and every week, we kind of go over some different things. I like to look at sort of the sector ETFs and the SPY at the same time, or the S&P index. The S&P index is up here, as you can see here on my chart, where we're looking at, obviously downward trend. There's the 50 crossing the 20. We know that we've been following this for months. Really, the only sector that's looking good on this chart, and I'm sure you're tired of hearing about it, is energy. You can see it right there. That's underneath the S&P, the SPX right now, on the chart, on this screen, so to speak. But there's your discretionary communications. Staples is even in a downtrend, along with healthcare. Now, these are defensive sectors, right? So we're talking about a lot of things kind of rolling over here at once that are supposed to be protective. We're going to get to bonds because they really failed us this year as well. But we were on top of it, and I hope you played along and were watching some of the things we talked about as far as fixed income. But there's your technology. Even industrials had a bit of a perk up here. They're doing a little bit better. They are positive on the day right now, as are materials. And that, folks, is really sort of a recessionary theme. Even financials, to a degree, are up slightly today, although not my favorite sector. But even saw real estate, moving in some downward moves. Really, the beginning of September was just a terrible time, for this particular sector, and that turned negative. And even utilities rolled over. So you got three defensive areas rolling over, and you really don't really have any respite in the market. You've got to basically, look and try to be in the right areas that are for you. Sometimes cash is king. If you watch CNBC today, Paul Tudor Jones, a very famous trader, was on there and was talking about, these yields are hard to ignore. I write about it every week in our Power Feed. It's called powerfeed.com. You can go in there and read those. We talk about these things constantly, and it's just a theme that's just not going away. And so let's look at the next chart here. U.S. dollar is really part of this problem, right? It's become a wrecking ball. You've seen a lot of magazine covers. Everyone's talking about it. We've been talking about it now for months. But here is the longer term chart. A lot of people forget back in 2000 to 2001, the dollar was pretty high. It was pretty strong, right? And what happened afterwards? I mean, the dollar rolled over right around that 2001 to 2003 area. It got back to about that par level in the beginning of 2003. And 2003, we did have a pretty good rally going forward into 2007, 2008 in the S&P. So I don't know if that's going to repeat it, but my point being is that everyone looks at these shorter term charts on the dollar. You got to look at the longer term. It's been here before, and it's recent memory. It's not, it's not like we're talking about 1950s here. This is year 2000 to 2003, not that long ago. Let's look at the next pattern here. Again, speaking of the S&P, when we look at the S&P, we're talking about daily patterns now for months. Now, I started writing this chart and building this chart back in March. We're talking about a head and shoulders pattern. I've shown you this where it hit the 4,300. That was sort of a coincidental area where the 200-day happened to be. Call it coincidental, call it algorithmic, whatever you want to call it. It hit there and turned around. Then obviously 4,100 came into place. See, I had two different levels there. 43 was where the original neckline was built. Some folks were saying I should use 4,100. Both seem to be important, but the measurement for the downside is coming from the head that's formed on the first neckline. We already hit that. And the second neckline, the 4,100, when I project it down, I'm getting 3382, which is about the pre-pandemic high as well. Here's the 19th. We continued. There's the 26th. I missed a week. And then we came here to the 10th. We are really drawing down. And currently, I think we hit about close to 3,600, 3,610, maybe 3,609 today. So something to be careful with. I mean, basically you want to watch and where these things are going. Bullish percent, we've been talking about this now. I've been using this in my career for many, many years. And it's been just a negative trend. You see the top one here is the bullish percent on the New York Stock Exchange Composite. The middle is the NASDAQ. The bottom is the S&P. We are in a negative trend, obviously. Now, last week it bumped up a little bit, but we really faded hard after those two big rally days. And obviously Friday was pretty bad. I'm just saying here, and I said this before, that longer rallies can lead to longer sell-offs. We're seeing the average rally has been roughly around 13 to 13.5%. We'll call it about 13 1/3 roughly. And that's just something that we can maybe prepare for. Any kind of news that we see trends starting to change in the near term, that could affect that. There's your Fang index on August 1st. There it is on the 26th. So we went from about 5,500 there down to 4,800. And today we're trading right around just under 4,600, maybe even lower now since I've built this. Also pre-pandemic high in the target area. Sentiment continues to stay bearish. AAII sentiment comes out weekly. You can see 2 weeks in a row, 21st to the 28th, over 60%. Historically, it's around 30. So it's been double. On May 10th, I was writing Afternoon Insights for many months. We talked about the rate. We got our target roughly, basically around June. About a month later, it kind of faded and then got back to that box and it's kind of sitting in there now. Now, as of Friday, we see it closing above that. The rates I took a snapshot of today were right around the same, up slightly on the day roughly, but here are your rates all the way from the 30. You see we're inverted here. Look at the 2-year at 4.3, look at the 30-year and even the 20-year at 4.1 and 3.8 on the 30-year. So in between that, we talked about something called the TLT. The TLT is basically the iShares 20-year Treasury ETF that trades. It's a barometer. People use it. I mean, I use it for, tracking sentiment and trade and things of that nature. And I've always said, if you're not bullish on bonds, it's hard to be bullish on stocks. I mean, that's basically just sort of a rule of thumb in a way, right? Think about it. Bonds are rising. That means rates are falling. That means stocks are rising, right? So we talked about 135 being an important level. This was on February 15th. I hope you were paying attention. So we talked about it. Now, we didn't have a target built until later, but my point being anything below 135 was a trouble area. And we talked about this in June about a target of 100. The 19th, we got really close at 107. The 26th, even closer at 105. And here we are today. I built this little target here from a Top Gun GIF out there. So you see what's happening in this. We're at 99. This is in a downward trend. It's been in a downward trend. Targets acquired. The next level on the chart really is around 97, which is not far away. I think it hit as low as 98 today. S&P, we had talked about 375 as a target many times. We saw this on June 17th, where we were back at 4,100. Obviously, we rallied, slightly, and then faded a little bit. Even into August, we rallied again, and obviously faded once again back into September. And here's where we are, where we were just a few weeks ago, and we're back there again today. And so that failure of getting above that previous target, remember, if it was support at one point, once it's breached, it becomes resistance on the way back up, and it's basically proving itself out here again, even on this level that we see. Q is about the same kind of thing. I mean, this one's just really trending with all technology stocks. But if you look at today, we've got a signal on the downside, and we also are overbought in a downward trend where we're testing lows. Never a good setup. Folks, I'm sorry, that's all we have for today. Again, thank you for tuning in. It's always a pleasure. Love the feedback, and I love the commentary here on the videos, so I appreciate that. Keep that coming. And we'll be here next week. Take care and be well.